why is the market been kind of stuck, and why is it not? Why hasn't it moved back to 4,200, 4,400, 4,600, or 4,800 plus, where all-time highs were at? That was well over a year ago. That was a year and a half ago or so, right? The main reason is everybody's been waiting for some sort of confirmation that earnings are going to be in the clear, one, and the second thing is that the Fed's done, okay? And so until you get that confirmation, everybody's kind of, we're just kind of stuck in this limbo of like, well, we can't really tank the market because earnings are actually coming in pretty respectable and decent, and we can't like go to some new number in the S&P really in a major way, because everybody's still concerned about earnings and concerned about how, if the Fed's going to go further and how much further they're going to go. If the Fed does raise, let's say 25 basis points, let's say they do that, okay, which Wall Street believes they're going to, and they say we're going to, pause, and, we think we've done about enough now at this point in time, then that's confirmation from the Fed side, right? So then you don't have to be concerned at all about the Fed raising anymore, so that takes that out of the equation. Then if you're talking about earnings come in respectable, let's say Meta, Amazon, all those companies, get through this quarter and then actually maybe report a decent second quarter with, expecting a strong back half of the year, then you can also talk about, S&P 4,400, 4,600 and going back to all-time highs of 4,800 plus. But you really need those two things, because that's really what's clouding the picture right now and making people, I would guess you would say, a little concerned and timid. Oh, the dollar's going to die and all this stuff. There's always, it's always the end of America. It's always, we're done. Oh, this is the time we're not going to be the ones anymore, right? This is the time we're going to get beat. You got to understand your whole thought process. If you believe that, this isn't the first time it's been like that. It's been like that for over 100 years now. Every single time they thought Japan was going to take over the world, and like Japan was going to run everything back in the 80s. Like that was the talk, right? And now we're looking at that and we're like, really, Japan was going to take over the world? They're going to run everything? Like, are you kidding me, right? No disrespect to Japan, awesome country, I'm sure, right? But let's be honest, like they're not even, remotely close to as important as, let's say, the United States is, or China, or, Europe, or many other various places, right? And right now, the whole talk was, China, and now there's the worries about, China and Russia and, what they could form, and, the dollar's going to die, and all this stuff, right? And so you just got to understand, like, this isn't the first time. And the more you understand history, the more you understand, oh, this isn't the first time we've gone through something like this. And it's actually a way more timid version of whatever we're going through, right? If you look at the Great Financial Crisis, people called that the worst recession since the Great Depression. And, you could make an argument, but at the end of the day, when you really looked at it, was it anything even remotely close to the Great Depression? No, it wasn't. Like, everything we kind of go through nowadays is nothing compared to what they would have gone through in the past. When you look at what we went through in the past especially in a high inflationary environment, like he speaks about the end of the 70s, beginning of 80s, right? Double-digit unemployment with double-digit inflation all simultaneously. I mean, that's a whole different dynamic than what we're dealing with. We've been dealing with high inflation, no doubt, but there's a big difference between what we've been dealing with versus, that past time period. If you ask me, like, would I rather go back to that time period or be in this time period? Definitely this time period. It's a lot easier to navigate this one, I can tell you, than that past one. Okay, so these are just things to consider in the when you're investing out there, and never get too cynical about all this stuff, because believe me, it's been way worse in the past. It's so easy for people to get into a mindset of, like, worrying about saving on groceries and this and that, and yet they don't spend more time researching companies they might be investing into, like he was bringing up at the beginning there, right? And I just like that's so vital. You know what I mean? Like, you're investing your money. Make sure you're investing your money in companies that you really believe in for this next 5-10 year period. And I think 2023, and I actually told everybody in the private stock group this last night, I said, I think 2023 is going to be the ultimate year to really see what companies you really want to ride out for the next 5-10 years and which ones you don't, right? Because 2023 is definitely a tougher operating environment, especially in terms of growth. And so the companies that can grow in a year like this, revenues, and have their margins and their net income strengthen as 2023 goes along, that's going to be very telling, because we're not in a hot business climate right now. And that's when you can really, differentiate between the companies that are really, truly strong and the companies that are only strong if the business environment is very strong at a particular time. Okay, so yeah, that was, I love it, man. Anytime Peter Lynch can be out there saying something, I think he does. Especially people like myself and you guys that are individual stock pickers. I think he's one of the most important folks out there, in my personal opinion, in regards to that. Chipotle. Okay, what the heck, Chipotle? You guys have the best earnings I've seen of any company so far this earnings season. I don't know if anybody's going to beat this earnings. This is incredible from Chipotle, okay? Great growth on top line. 236 they did for revenue in this latest quarter versus just over $2 billion. That's a phenomenal growth. That's over $300 million of growth in terms of revenue there, okay? Food and beverage packaging down year over year. That's great news. Labor as a percent of revenue down year over year. Occupancy down year over year. Other operating costs down year over year. General administrative expenses down over year. And all total operating expenses were 90.6% of revenues last year in the same quarter. Now they're down to 84.5% in this latest quarter. That is amazing. Income from operations was up substantially, $367 million versus $190 million here. So now their income from operations is, 15.5% of revenues. That's incredible. From 9.4%, what a turn. What a turn for Chipotle. As far as net income, now they have a 12.3% net income percentage versus revenues. That's incredible. $291 million net income versus the same quarter last year, $158 million. You got to be flipping my flapjacks. EPS, $10.56 versus $5.64 in the same quarter last year. If I was a Chipotle shareholder, CMG, I would just be jumping over the moon. It literally doesn't get better than that. That's incredible, man. To have that sort of revenue growth and have your expenses fall in line, especially in this environment. Sure, inflation's made a lot of progress. We're making progress with inflation, but let's not fool ourselves. Inflation's still high, right? Incredible numbers out of Chipotle. Enphase Energy, this one, tough, right? Down over 16% after hours here, roughly, for Enphase. And do remember, in the last 52 weeks, this was a stock that was nearly $340 a share, right? So basically, the stock's been, let's call it about cut in half now at this point in time, right? And we'll speak about the real reason why this stock is down so substantially, okay? Now, if we look at a sequential basis, right, revenue growth is basically stalling out for Enphase at this point in time, right? Which, for growth stocks, a lot of people look at sequential basis. They're like, yeah, it's great year over year, but whoa, what the heck's going on here? Our growth is also stalling at this point in time, right? Net income on a sequential basis actually down on a sequential basis. Oh boy, okay? EPS actually down on a sequential basis. And if you look at non-GAAP, right? On a non-GAAP basis, they went from $212 million in Q4 to $192 million. So for a stock like Enphase, folks, this is a epic problem, okay? Because this isn't necessarily a cheap stock. If this stock was valued at a 20 forward P, it's a different situation, right? But this stock's been valued 65, 36 forward Ps on the stock. And if you're talking about the possibility that growth is coming to a standstill here, I'm just telling you that's going to freak out people in a massive way when they're in a stock that is a higher valued stock, right, in terms of valuation metrics. And so this is, freaking a lot of people out of Enphase, and they're really going to have to figure out, where's growth going with this company? Are we really stalling this baby out? Is this going to be like a 5% grower, 10% grower? Could revenues go negative? These are thoughts that creep into people's minds, okay? Doesn't mean it's true, doesn't mean it's accurate. It's the thoughts that creep into people's minds when they see a sequential quarter that bad, okay? And that's why the stock is down 16+% here after hours, right? And we witnessed this go on with Tesla, right? Why has Tesla gone down 51%, 52% over the past year? Because this one had a big valuation on it and growth slowed in a massive way. So when you are dealing with these, this is one of the big risks with growth stocks, right? It's exciting. Growth stocks are exciting, right? I own a lot of growth stocks in my portfolios, obviously, and I believe they had tremendous 3-year, 5-year, 7-year, 10-year futures in front of them. But at the end of the day, when you're a growth stock and that growth starts to stall, it's not quite what it was. You're going to see a mass movement out of that stock. And you will see an epic move down in the stock price of that particular company. And that's exactly what we saw in Tesla over the past year. It's exactly what we're seeing in end phase now. You saw this also with Shopify. You saw this with Netflix. I mean, we could go through the list of stocks. When you come off of great growth and all of a sudden you're like barely growing, or there's even a thought process about, is this company's revenues going to go negative? Is that a possibility? It absolutely wrecks the stock price of that company, okay? And so that's why end phase is down massively, and it is a risk factor we all have to consider whenever you're investing in a growth stock, is can they keep, value stocks have their own risk, dividend stocks have their own risk, right? Of like, can they keep their business model stable and growing, just a few percent a year. With growth stocks, if all of a sudden you go from, 40% revenue growth to maybe 20%, that could mean your stock price is cut 40, 50%. And it happens fast. We're talking about months. We're not talking about years. We're talking about months, okay? And so just always keep that in mind, folks.